So, markets took a big number to yesterday. We saw semis take a huge hit, with 10 out of the 20 biggest losers from my general watch list being AI or semi-related. We can see the same huge hits for the biggest losers in the S&P 500, the Nasdaq, the Dow Jones, and the Russell 2000. But having such dips does not mean that you just should buy any and each dip in the market. There are certain stocks that you should absolutely avoid in this dip. So here are 3 stocks that you should be staying away from, in my opinion, in this dip, as you might be positioning yourself in a bad place. Now in this video, I will go for a stock in each of the 3 market cap categories that I have set for my portfolio, being these small caps, the 10 billion market cap hyper growth like stocks, the mid caps 15 to 40 billion high growth, creating a moat, and having a strong market position, and a large cap, a $60 billion plus company with strong growth, but also a dominant market position. Now, I've picked one from each category, like I said, and at the end, I will give you another prediction about the markets, a bit of a handy insight, and I will also give you one stock that I will actually be looking to add in this market drop. Now, before diving into the first stock, I would recommend you not to buy. Let me first get this disclaimer out of the way, because this is not financial advice. This is just some video on YouTube. But I will start by just a easy one, which I will just throw in there because it might be very predictable and I didn't want to actually use it for the video. But it's Nvidia. So why Nvidia? Well, I think it's been commented on quite a lot, but we have seen such a pull forward in demand that we can see it in the stock price here. It's just gone up so much that, well, a lot of the potential growth for this company has been priced in. The growth has to continue to go in order to, well, justify where it's going. Now, from the people that invest in Nvidia, a very common assumption you hear is that with this new AI boom, the cyclicality of the semis has been taken out. And somehow it has never really clicked that well when we say this time is different. So I'm not gonna go for this time is different for Nvidia. And I think there will still be cyclicality. Because, well, what's gonna happen when you have the chips? Are you gonna update them each year, each 2 years, each 4 years? I don't know, but the prices they are at right now, are they gonna be maintained? Are they gonna stay this high? I don't think so. I think the supply chains will catch up to the demand, which means prices will fall, which means margins will go down for Nvidia. Now that means, of course, not as favorable as the stock price. Okay, so if we have Nvidia out of our way, we get to the first one, and that's e.l.f. Beauty, e.l.f. Cosmetics. And the why is actually quite simple. Now, when we look at e.l.f. Beauty, we can see that since the latest earnings report, the share price is down by about 25%. Now, we can also see that since November last year, so over the past year, the stock is now still up 56%, but it peaked out at over 140% growth. Now, that's in the share price, not in the actual numbers. So a lot of it is multiple expansion. And that's quite important to note here, because that's what I think is part of the issue. Now, a few weeks ago, I made a video about e.l.f. and I said that they are having a problem. I call this video, or I had this video saying, we've got an elephant problem, or this is an elephant problem. Basically the same language they use, so I thought that would be funny. But in this video, I also highlighted what I thought was a realistic price for e.l.f. Now, I showed this chart, and what I said was that based on a forward PE metric, I think the stock should be trading between 105 and 125. Now, we are at 140 right now, so we are getting closer, but I do think it still has some weakness to come. Now, based on the free cash flow, I had them at a price target of $95. And well, $95 still is quite a bit down. And why did I think e.l.f. might be crashing? Well, that's because of, well, let's look at Coifin. So right here we have Coifin. And what we can see is the PE that's at 66.8. Now, when we hold our mouse there, we get a nice graph of how this is historically looking. But the PE is backwards looking. So that's, of course, not the most interesting part. But the forward PE of 39.5, that's a bit more, I'd say, interesting. And what we can see that it's not quite on the low side, but not that extremely high either. But there is a difference between what's going on right now and what has been happening historically. And I will get to that in a second. But what's important to note here is that we see these sales estimates. This is for the first fiscal year out, the second fiscal year out, and the third full fiscal year out. And we also have the EPS. Now we have first fiscal year out, second fiscal year out, third fiscal year out. And we don't see that many downticks. That might be different for other companies. But we can see the year-over-year change. And we see in revenues especially. We see 29% growth estimate, 18% growth estimate, and 17% growth estimate. This is a big downtick from what it has been, how much the revenue growth has been. And that's not something that markets like. They want you to see, or they want to see growth, and they want to see the growth, well, that it just keeps going. Now, what I mean by that is when we look at the prior earnings reports, we can see that ELF, during Q4 of 2024, fiscal 2024, they had 78% year-over-year revenue growth. Then they had 76, 76, 84, 71, and now 50. And they are expected to do 34, but this is way above their guidance. So what we are seeing is a massive slowdown in revenue growth. If we look farther out, we see 21%, 17%. And in my opinion, this is really optimistic. And I'm going to show you exactly why. Because what we have here is the updated fiscal 2025 outlook and the previous outlook. But what we see is that the updated outlook, it has barely been tweaked. It has been guided up by about $50 million in revenues, about 4%. We see the adjusted EBITDA, slight increases. Now the tax rate stays the same. Adjusted net income, that's been increased by 11 million. We see the adjusted EPS per share. Well, that ticked up a little more, but not as much. And then the fiscal year ending diluted shares outstanding, that stays the same. Now, historically, ELF has been upgrading their guidance or updating it, improving it by way more than 4%. We've seen quarters in which ELF upped their guidance by 10 or even more percentage points. Now, if you want to see more of that, you should check out my video that I made. This is ELF in bed, because there I highlight this even further. But what ELF is doing right now is basically saying that they will not have any revenue growth from Q1 to Q4 in their current guidance. So either they are going to upgrade their guidance in a massive way, or they have a real slowdown going on here. And that is quite scary. And I don't think this stock is pricing in any of it at all. Because once again, when we look at this chart with a 39.5 next 12-month PE ratio, tell me how much of that revenue growth shrinkage has been priced in. I'd say nothing whatsoever. So then it's time for stock number 2. And stock number 2 is Crowdstrike. Now, Crowdstrike has been on a, quite a massive drop recently. If we can see right here, the stock is down about, or was down about 46% after their content update. Now, since then, the stock has rebounded by about 30% up till now. However, I don't think you should buy the stock when it dips. And the reason is very, very simple. Because if we look at Coifin, once again, we can see a next 12-month PE, a forward PE of 72.5. Now, if we look at this chart, then this number looks really low. And that's of course true. But it isn't. Now, if we look at the revenue growth, the estimates that analysts have, so fiscal year 2025, we see an estimation of 3.9 billion. This has been slightly curving over, right? Then we have 2026, we have 23% revenue growth, which is quite good, at 4.8 billion. Now here we see that curve going a bit more already. Then we have fiscal 2027, 21% revenue growth, at 5.8 billion. But let's just open this chart for the fun of it. Because here we see that it was in January at about 6.6 billion, and now we are at 5.8. So we've gone down 900 million this year alone. But that's not all of the story. Because if we look at the EPS, we can see EPS growth for 2025 of 17.8%. Now this is a long way down already. Then we have fiscal 2026, 19% growth. We can see it coming down even more. Now this number is quite volatile, okay? I acknowledge that. But we see 4.34 right there. And now we have fiscal 2027 at $5.41 and 24% EPS growth. But when we look at this number, you see the issue right here? This is a massive drop in the EPS expectations. So that's 72.5 next 12-month PE. You really think that's gonna come down? Because I think this is gonna go lower. I think Crowdstrike will have an issue with their growth. Now the reason I think so is very, very simple. Well, there are two reasons. So the first one is that, well, the cybersecurity space, it's really competitive. They have a lot of competition going, and they all try to differentiate itself, or the companies try to differentiate itself in unique ways. Now, the cybersecurity is also a very difficult market to understand, or a difficult industry to understand. And in order to buy this dip, make sure you really understand the differences. What makes each company unique? So why is Palo Alto Networks different than CrowdStrike? And I mean, Fortinet has some clear differences, but really make sure you understand the differences and why one is positively or better than the other. Now, the second reason comes through the outage or the update that they did in July, because we know Delta Airlines is suing the absolute garbage out of them. And they will not be the only one. CrowdStrike will face many more lawsuits, in my opinion, about the outages that they caused with a simple update. We can also see it here from Wired. They also say the same. CrowdStrike faces a potential tsunami of lawsuits. Only the fine print can save it, experts say. After crashing millions of computers and disrupting businesses across the globe, cybersecurity company CrowdStrike must protect itself against a flurry of legal activity that is already beginning. And the devil will be in the details. Now, this article was from August 7th, so it wasn't the immediate response, the first thing that they posted. It was after some consideration. And I honestly think, more and more companies will start suing CrowdStrike in order to get back the losses they made. And if they don't, they will surely use it in their next contract negotiations. And CrowdStrike will have to give some of it. And the third one, you may either see this as an easy one or a bit of a controversial one, but it's the biggest company right now by market cap, and it's Apple. Now, why Apple? Because doesn't that stock just always go up? And I mean, you wouldn't necessarily wrong by saying so. Because if we look at the 5-year chart, we can see, Apple is up quite an impressive amount. We look at the 10-year chart, that looks quite amazing, doesn't it? Now, the issues with Apple come from the last 6 months. Because Apple had the WDC and the WDC event, and there they announced the new tech that's gonna go into their newest iPhones. And what happened was that the stock just absolutely shot up. It just went insane. And the reason why was quite simple. Because Apple announced Apple Intelligence. They announced to use AI, which they reframe as Apple Intelligence, in the new phones. And analysts took this as everybody will want this. Every single person should want this. And in my opinion, that's just not true. If you look around you, how many people use AI? I'd say not that many. Maybe we search something on ChatGPT, use the Google AI for a search query, or maybe even Bing. But how many people actually are that enthusiastic about AI that they will go their way or will go out of their ways to look for stuff that has it? How much market share has Google taken, the Google Pixel phones taken from the iPhones because they used some AI in it? I haven't looked up the number specifically, but I think it's basically nothing. Because the average consumer just doesn't care, in my opinion. Now, the next iPhones are expected to be bigger phones, and that will really help the sales. However, throwing it on AI, Apple Intelligence, is just completely wrong, in my opinion. Now, if we look at Apple with their next 12-month EPS estimate, we can see that this number is, historically speaking, not really that low. We've seen it pop up to the numbers it is right now, basically after the pandemic. We see the slight drop right here. And I mean, this is the pandemic. This was the first lockdown, the first market crash of 2020, after which the forward PE numbers for Apple just absolutely shot up. And I'm not going to say this is not sustainable, because I mean, Apple is a very, very high quality company, but I don't know how much more multiple expansion they can have. Because if we look at the EPS increases, we can see 9%, we can see 10.8%, and we can see 12.8%. So it's not going to come from EPS growth with the growth of this stock. And I think all of the growth that is going to come from the new iPhone and the new super cycle that is so widely expected has been fully priced in. Now, the new iPhones will be announced, I think, later this month, I believe. And historically speaking, this has been a buy the rumor, sell the news event. So if we have the stock coming down right now, with a buy the rumor, sell the news event coming up, then is it smart to actually buy it right now? I don't think so. Besides, I believe there is something else happening in the coming weeks, which is also going to be, well, not helpful for the stock market. Let's just put it at that. Allow me to explain what that is, and then I will tell you which stock I actually am looking to buy. And that might also be a bit of a controversial one. Now, what I want to look at with you is, well, right here, this chart. And what we have right here, and what I want to highlight is this right here, is the election from 2020. Because we see a lot of volatility right there. We see the stock market going down, popping back up, gonna go back down, because there is uncertainty. Who's gonna be president? Which policies are gonna come from that? And especially this election cycle. This is some very big question marks, because we basically look at two polar opposites. So how interesting that may be, the stock market is seeing a lot of uncertainty because who's going to become president? And like I said, the policies, what's going to come from it? Okay, so then right here we have 2012. And once again, we see it from September to November. We see the stock market dropping. And right here we actually see a drop of about, well, 8.5% peak to trough. We can see 2008. Once again, it was, of course, the stock market crash, the great financial crisis. But we see in September, we suddenly see it shifting downwards even faster. Up to right about here. And I mean, this drop is massive, of course. But here we see it dropping as well, by quite an extent. We can go to 2004. and we see it once again. Well, a bit of an anomaly here because we have September and then to October. Let me do it like this. And it's not going down that much, and actually halfway in October or towards the end of October, we see the stock market going up again. But we also see this about 5% correction from September into October, to the end of October. Now, then we have the 2000s, and the 2000s we also see right here, a peak in September. Basically just, of course, we had the tech bubble, but we see it trending downwards into November. A small pop, and then back down again into December. But we see that market volatility again. Now for 1996, we had a bit of an anomaly, because here we see the market's bottom actually in September, and then just going up into the election. This is the only election cycle where I found this, but the market actually rallied into it. Now then we had 1992. And I actually had to switch from the SPY to the SPX in order to show it right here. But once again, only in the few days leading upwards, but we did see a drop going into the election, or once again to the middle of October, of about 5%. So we can see a pattern here, right? I mean, I'm not the only one seeing this. So with the market starting to drop at the beginning of September, there's a high likelihood that this will continue to show weakness or volatility going into the election. Especially since we are now about 50-50 split. And I mean, there are big question marks about who's gonna win. So that's gonna give markets uncertainty. And uncertainty is never liked by the stock market. Now then there is one more thing to discuss. And that is the stock that I am actually looking to buy, because I think it is priced quite fairly already. And if the stock market continues to dump, and this stock as well, then it might become a really interesting pick. And that pick is Google. And you might say, why Google? What's so special about it? And my answer will be, not that much. When we look at the share price, we can see that it has been coming down quite a bit. We see sales estimates, 13%, 11%, 10%, so that is not that high. We see EPS expectations, 30%, 14%, 14.8%. Not bad, but around the 14-15% mark, not the highest out there in the stock market. But what we also see is a next 12-month PE of 19.7. And we see in this graph that the PE has always been somewhat lower for Google. And there's good reason for it. And that is uncertainty. But let's first look at the chart a bit more detailed, because what's a bit of a fun background is that in March, my first ever video was about Google. They had the Gemini issues, and all social media was roasting Google as if it was going bankrupt, as if it was gonna absolutely lose the AI race, and there was no place for it. Bing would take over, OpenAI would take over. Basically, Google would have gotten nothing done, according to social media, according to popular opinion. Now that was March, right here. And after I made that video, and I didn't buy it, of course, because why would I buy it when I think a company is selling off for all the wrong reasons? Would be too logical to do so, of course. The stock rocketed up about 45%. 45% in just a few months? Might be a shame if you missed out on it, right? But since then, the stock has been coming down and is now down about 17-18% from that peak. And I think it might continue to trend down for the upcoming weeks. But we do also see it right now exactly at the 200-day simple moving average, which has historically, as you can see right here also, been quite a good buying point. But why is the forward PE of Google this low if it's such a big company and such a predictable company? And the reason is quite simple. Now, I've said this for all stocks basically, I think, maybe not for Apple, But there's something quite simple about Google, and that's the latest issue. Now, the US said to consider a breakup of Google to address the search monopoly. The Justice Department and State Attorney General are discussing various scenarios to remedy Google's dominance in online search, including a breakup of the company. So how all of that is gonna look is not that well known just yet. But we do know Google has some great parts of the business and some lesser parts. And what I mean by that is the growth, basically in Google Cloud, and the profitability of the search business. Now, if we look right here, we can see the growth in revenues. And we see that Google Search grew 13.8% revenues. We saw YouTube ads growing, 13.2% revenues. We saw Google Services grow by 11.53% in revenues. And we saw Google Cloud grow revenues at 28.8%. But the fun part comes at the profitability growth. Because if we look right here at the operating income, we see that Google Services grew their operating income by 26.5%. Remember, this is a company that's worth, 2 trillion, I think? 1.8 to slightly over 2 trillion. That's growing their core business at 26.5% in operating income. The Google Cloud, which is probably their next big pathway for growth, grew their revenues, they almost tripled it. Now, if you agree with me on this list, make sure to let me know. If you do not agree with this list or think that I made some very dumb points, also make sure to let me know and let me know why you disagree or agree with me. Now, if you enjoyed this video, please make sure to subscribe to my channel because a lot of effort is going into making these videos. And also give me the thumbs up as this helps me a lot with the YouTube algorithm. And with that being said, thank you for watching and I hope to see you in my next video.